Working with clients, I hear the same worry again and again. If I'm single in retirement, am I just out of luck from a tax perspective? People see couples income splitting, sharing survivor benefits, and wonder if the same system leaves singles behind. And here's the real risk. If you assume there's nothing you can do, you could end up paying far more tax than necessary, lose out on old age security, and leave a bigger bill behind for CRA when you pass. So in this video, I'm tackling this head on. We're gonna walk through smart, practical strategies designed specifically for single and divorced retirees. Whether you're still a few years from converting your RRSP to a RRIF, or you're already receiving CPP and OAS, I'll show you how to claim credits, smooth out your income, avoid clawbacks, and plan your estate more effectively. The goal is simple: to give you a clear, workable playbook so you can keep more of your money and feel confident about your decisions, even without the option of income splitting. If you're new to my channel, welcome. I'm Jacqueline Ozdemir, a financial advisor here at Ferguson Financial Planning. I spend my days helping Canadians make sense of the real-life challenges that come with retirement planning, especially when the tax rules and income programs feel like a moving target. Over the years, I've worked with plenty of people who assumed being single in retirement meant fewer options, only to discover there are actually unique advantages once you know how to use them. And that's exactly what we'll cover today. In this video, I'll share 6 practical strategies that singles can use to retire smarter, why not having a spouse doesn't mean you're left out, how the Mini-RRIF strategy unlocks the pension credit at 65, and steps you can take to avoid losing old age security to clawbacks, the order of withdrawals that saves tax, why estate planning is even more critical if you're on your own, and finally, real case studies that show these ideas in action. Before we jump in, a quick reminder. If you find this helpful, please hit like, drop a comment below, and don't forget to subscribe so you never miss future videos. All right, let's get into it. Let's start with a big misconception I hear all the time. If you're single in retirement, you're automatically worse off because you can't income split. And I get it. It feels that way when almost every article or retirement webinar out there seems designed for couples. When you're on your own, whether you're divorced, widowed, or you just stayed single, it can feel like the system wasn't built for you. But here's the good news. Singles actually have certain advantages that couples don't. One of the biggest advantages, you have full control over your withdrawals. You don't have to constantly balance your income with a spouse's or stress about optimizing 2 people's tax brackets at the same time. With one income stream to plan around, your decisions become more direct and in some ways simpler. Think of it this way. Couples get locked into joint decisions. They're always balancing between one person's needs and the other. Singles can act faster, shift strategies more easily, and take advantage of opportunities by themselves. For example, you can decide exactly when to start drawing from your RRSP or RRIF without worrying about whether it'll bump your partner up into a higher tax bracket. Here's another overlooked perk. Because OAS Clawback is applied to each individual, not a household, your focus is entirely on your own return. There's no need to run 2 sets of numbers and try to minimize combined income. That means singular planning, and in the right hand, that's a point of strength. Now, does this erase the fact that couples can income split and reduce overall tax? No, that can be a benefit. But for singles, it isn't all downside. A well-structured game plan still allows you to keep control over your taxes, reduce clawbacks, and stretch your income. The key is knowing the tools that are available to you, which brings us to one of my favorite strategies for singles, the Mini-RRIF at age 65. One of the most powerful strategies for singles turning 65 is setting up what I like to call a Mini-RRIF. Why does this matter? Because it lets you take advantage of the $2,000 pension income tax credit. If you don't trigger eligible pension income, like RRIF income, you miss out on the credit completely. It's you use it or lose it. Here's the step-by-step idea. You don't need to convert your entire RRSP into a RRIF at 65, just a small slice. Move about $20,000 from your RRSP into a new RRIF or plan to top it up each year. From there, withdraw $2,000 per year. That withdrawal qualifies as eligible pension income, which lets you claim the federal pension income amount, and in Ontario, a provincial amount as well. So what's the net effect? In Ontario, between the federal and provincial credits, you can often pull that $2,000 out essentially tax-free every single year, depending on your tax bracket. Over the course of 10 years, that could be $20,000 of tax-free income that's pretty much gifted to you by the government if you know to do it. So let's bring this to life with Shauna's example. She's 65, divorced, still does some part-time consulting work, and has a modest income. She has about $600,000 in her RRSP. She sets up a mini-RRIF with $14,000, and each year she pulls $2,000 from that RRIF. Because she's claiming the pension income credit, her tax bill doesn't really go up. She basically just added an extra $2,000 of annual after-tax income to her retirement cash flow. Year after year, this tactic saves her about $400 in tax that she would have otherwise paid. It might not feel like a giant lottery win, but think of it this way. That's like finding a free $400 bill in your winter coat every year. And the best part is that this is available to anyone who understands how to play the rules. So you don't necessarily have to wait until 71 when you're forced to convert the entire RRSP. You can look at starting with a mini-RRIF at 65, which gives singles a tool that couples often take for granted through income splitting. For you, it's a direct bonus. Now, let's talk about the real villain for many retirees, the old age security clawback. For those not familiar, the clawback kicks in when your net income passes a certain threshold. In 2026, that threshold is just over $93,000. Go over that amount and the government starts taking back 15 cents of your OAS for every dollar above it. Push it high enough, around $152,062, and you lose the entire OAS benefit. For singles, this matters even more because you don't have the option of splitting income with a spouse to stay under the limit. The income is all on you, which means planning ahead can make the difference between keeping OAS or watching it vanish. Here's a quick story. Mark is 70, widowed, with $1,300,000 in his RRSP. By December 31st of this year, when he turns 71, he must convert to a RRIF. His first required minimum RRIF withdrawal starts next year, and he will be required to draw out 5.28% of his January 1st RRIF balance, which in his case means he'll be forced to take out roughly $68,640, whether he needs it or not. Add in his Canada pension plan and OAS, and suddenly he's well over the clawback threshold. Now, if Mark had instead started pulling more gradually from 65 to 71, for example, when his taxable income was a bit lower, he could have reduced the size of his RRSP. Let's say he withdrew $20,000 per year for 7 years before his mandatory RRIF conversion. That reduces his RRSP by $140,000, which then makes his mandatory withdrawals at 71 smaller, reducing the OAS clawback. So the lesson is this: singles need to manage the timing game from 65 to 71. If you wait too long, your income balloon can pop and push you into clawback territory. But by taking control withdrawals earlier, you smooth out the graph, keeping income steady, avoiding sharp spikes, and holding on to your OAS checks. According to experts and updated 2025 guidelines, this clawback isn't going away. It's adjusted annually. With CPP, OAS, and RRIF withdrawals combined, a lot of Canadians end up surprised when the government claws back part of their benefit. For singles, you cannot rely on income splitting to patch it over. The earlier you plan, the more you protect that steady OAS income stream. Another place where singles have to be strategic is in the order you tap different accounts. You've got RRSPs, TFSAs, and maybe some non-registered investment accounts. The order matters more than most people think because it shapes how much tax you'll pay over your lifetime, not just this year. The typical thinking is use up non-registered money first, then RRSPs, and save the TFSA for last. And for many singles, that's a smart framework. But here's where it gets interesting. You also need to consider how those withdrawals line up with OAS clawback limits. Here's a plain example. Let's say Catherine is 68, single, and her RRSP sits at $1.5 million. On top of that, she still receives corporate dividends each year, which get grossed up for tax purposes and can push OAS over the line faster. She's well past the OAS clawback limit already. In her case, saving her RRSP for later could actually make things worse because the forced RRIF withdrawals will be large and heavily taxed down the line. The alternative strategy, she should start drawing more aggressively from her RRSP now while she's still younger and move the after-tax money into her TFSA. The TFSA becomes a long-term storehouse of tax-free compounding wealth, and withdrawals from a TFSA don't count towards OAS clawback income. If she simply left the RRSP untouched, the large balance might take a heavy tax hit when she dies because for singles, RRIF balances are fully taxable at death. So here's a sequence that often could make sense. Non-registered assets, draw those earlier while capital gains are still manageable, then start pulling from RRSPs strategically from 65 to 71 to reduce the balloon effect later. Meanwhile, contribute steadily to your TFSAs since it's the ultimate flexible tool, it never triggers tax, and any withdrawals don't count toward OAS clawback income. Think of it like a 3-bucket system. You sip from one bucket, pour into another, and preserve the third. The overall goal isn't to minimize tax only in this year, but to spread taxation evenly across the years, so you don't get hit by surprise spikes. Now let's get into estate planning, because this is where being single really stands out. If you're married, RRIF accounts usually transfer directly to your spouse on a tax-deferred basis. For singles, though, that safety net doesn't exist. When you pass away, your RRIF balance is fully included on your final tax return. So if you've got $1 million in your RRIF account, expect the tax bill to eat up a massive share of it, sometimes close to half, before anything flows to your beneficiaries. That's the tough reality, but here's the opportunity. With good planning, you can soften the final blow. Let's explore 3 main tactics. First, staggered withdrawals. Instead of leaving your RRIF to balloon, you deliberately reduce it during your lifetime, paying tax at a lower personal marginal tax rate gradually. Yes, you pay taxes sooner, but you avoid the huge lump sum shock later. Remember, your estate will pay tax on your RRIF at the highest marginal tax rate, currently at 53.53% here in Ontario if you have a large RRIF. Second, make the most of your TFSA. If you pull RRIF money each year and contribute the after-tax amount to a TFSA, that money essentially gets removed from the estate tax drag. When you pass, the TFSA flows out tax-free. And third, consider pairing your estate strategy with life insurance. Some singles choose a permanent policy, not because they need the income replacement, but because it creates a tax-free pool of money that can fund the tax on their estate at death. Here's a real scenario. A client passes away with a $1 million RRIF. With no spouse, the estate pays almost $500,000 in tax, leaving only $500,000 for heirs. Now, that's a bit of a high estimate, but I wanted to use this for the purpose of this example. So if that person had gradually reduced RRIF withdrawals earlier and topped up their TFSA and bought a life insurance policy, the heirs might receive closer to $800,000 in value. That's a jaw-dropping difference, and it all comes down to structure. The key guardrail for singles: your estate plan isn't just about leaving gifts, it's also about protecting against a tax shock that couples don't face in the same way. Let me finish with a few case studies to show how all these pieces come together in real life. We already talked a bit about Shauna, who's divorced at 65. She used the Mini-RRIF strategy to collect $2,000 tax-free every year, saving around $400 annually over a decade. That's $4,000 saved and $20,000 of extra income that didn't inflate her tax return. Now back to Mark, age 70, widowed with a $1,300,000 RRSP. His looming mandatory withdrawals at 71 would push him above the OAS clawback threshold. By drawing $20,000 per year from age 65 to 71, he lowered his RRSP by $140,000 before conversion. That one move saves him from losing thousands in clawed back OAS benefits during his 70s. In this example, the clawback is reduced, but note that there is still some clawback. And then there's Catherine at 68. Single and already in high income territory. She realizes OAS will be clawed back no matter what. For her, the battle isn't about clawback, it's about estate tax. So she starts drawing her RSP now while she can still manage the tax bracket, moving as much as she can into her TFSA each year. She also sets up a charitable giving plan, directing some of her RRIF to a registered charity at death. That designation lets her claim donation credits up to 100% of net income in the year of death or carry back to the prior year, which can substantially offset the tax triggered by the RRIF. The end result, she reduces the final hit and creates a smoother transition. These aren't edge cases, they're common scenarios for singles, and remember, the government adjusts benefit thresholds each year. For 2025 income, the OAS clawback starts at $93,454. If you convert your RSP at 71, the first required minimum is paid the next year using the age 71 factor of 5.28%. On a $1,300,000 RRIF, that's about $68,600 added to income. Add CPP and OAS, and you're easily brushing up against those clawback levels. So the lesson from this case study is simple. Being single doesn't mean you're robbed of opportunity. It means you get to chart your own strategy with full control over timelines, withdrawals, and estate outcomes. The difference between winging it and deliberately structuring it can be hundreds of thousands of dollars saved over your lifetime and more. And more importantly, it can give you confidence that your retirement income isn't being chewed up by unnecessary taxes. So if you've been feeling like retirement strategies are designed for couples and you're somehow left out, I hope this flips the script for you. Singles actually have plenty of powerful levers. You just need to know which ones to pull and when. So let's step back and connect the dots. What we've seen is that being single in retirement isn't a disadvantage. It's simply different. You don't have the lever of income splitting, but you do have freedom of control. The Mini-RRIF strategy at 65 ensures you collect valuable credits instead of leaving them on the table. Thoughtful withdrawals from 65 to 71 can protect your old age security from clawbacks. And choosing the right order, from non-registered accounts to RRSPs to topping up your TFSA, helps spread taxes evenly instead of creating nasty spikes later on. Estate planning becomes especially critical because without a spouse, large RRIF balances can shift straight into taxable income at death. But with staggered withdrawals, TFSA funding, and even strategic insurance, you can turn a potential tax problem into an opportunity to leave more behind on your terms. The implication here is powerful. Every single decision you make on timing, order, and structure compounds over years. Done right, it can mean tens or even hundreds of thousands of dollars saved. Done casually, it can erode wealth unnecessarily. The real takeaway: singles don't just need a plan, they get to build one that works purely for them. And that really ties a bow on everything we've covered today. If you're single in retirement, you've got unique advantages and levers to pull, but the difference comes down to whether you actually use them. Now, I'd love to hear from you. What's the one part of retirement planning that feels the most confusing? Timing withdrawals, handling old age security clawbacks, or figuring out the estate side of it? Drop your thoughts in the comments because I read every single one and your question might show up in a future video. In fact, some comments from previous videos inspired this video here today. If you'd rather have an experienced team handle the planning, coordination, and implementation of these strategies so nothing gets missed and nothing gets done twice, click the link in the description to book a discovery call. It's the first step in seeing whether we're the right fit to take the lead on optimizing your withdrawals, protecting your old age security, and structuring your estate plan. Lastly, if you found this helpful, hit subscribe and turn on notifications so you don't miss the next strategy we break down. Thanks so much for watching, and I'll see you in the next video.